I would still say I am lucky to see one company where I fall out of my chair a month. Everyone talks about deal flow. I think they all lie or are delusional, right? I was just talking to someone, watching a video this morning where someone was saying how they had to see 1,000 deals last year. I'm like, well, I mean, I guess it's possible.
Today's episode features Jason Lemkin, founder and CEO of SaaStr Fund, a venture capital firm specializing in early-stage enterprise investments. We discuss the challenges for scaling a venture firm and how he thinks about media and event strategies. Here's Jason.
Well, this episode, I'm trying to do something different than what I've heard in other episodes. And I've heard almost every podcast I think you've been a guest on. And I'm trying to go deep on the business.
I don't do that many, actually, but yeah.
Yes, I'm trying to go deep on the business of SaaStr, both the fund and the business. So first, I'll just start by saying thanks for coming on the podcast. Really excited to have this conversation.
Thanks for the time.
Okay, Jason, why don't you give us from the origin? You're one of the very few people who's built a sizable venture fund and also a sizable business next to each other in ways that complement each other and are synergistic with each other.
At least seemingly so.
Yes. Very few people have done that, right? Harry Stebbings has done it in a smaller capacity with doing VC. But why do very few people do that? And why have you decided to do it that way?
Well, look, Harry's done it in a big capacity. Ultimately, he will do it in a way much bigger than me. I think I was kind of a historical accident to both investing and I guess to building a media company, if that's what we want to call SaaStr. I think of it as a community. The term community has evolved a lot, so we can call it media, but I started early. I started in 2012. I started the day I left Adobe after my last startup was acquired, a company called EchoSign. And I queued up 100 blog posts of my learnings as a founder, and I wasn't allowed to do them as a corporate vice president. It wasn't a negative for Adobe. It just required a lot of oversight. So I didn't end up publishing my top 100 learnings. And whenever the first SaaStr post was in 2012, I had 100 queued up in WordPress. But it was really just me sharing my learnings. And I myself, in some ways, was inspired by Mark Suster's blog, which a lot of us who've been around a long time used to read. And I wanted to do a SaaS version of it and all the mistakes I made. I started at the same time as David Sachs at Yammer, Renee Lessert at Build, and Aaron at Box, and Peter Gassner at Viva. And obviously, they were all much more successful than me, but I was the first with an exit. So I was the first one that had nothing to hide. I didn't have to pretend. I didn't have to pretend I was better than I was or things were better. So I just shared my learnings. And in fact, the original dumb title was Katharas. So stupid because it wasn't meant to help me. It was meant to be cathartic for other founders, but Katharas rolled off the tongue even worse than SaaStr. Although I may own don't steal, whoever's listening to this or watching, don't steal the domain name if I didn't take it. But that was actually the original title was Katharas. But we could talk about why it actually took off. And, now that I watch what other folks have done, 2012 was very early for social media because social media has changed so much, right? But it did take off, at least within CEOs and founders, right? Within a core group. And then not much later, I got recruited to join the VC firm, one of the VC firms that had funded me. And I really had never done investing before. I'd been a founder multiple times. I'd pitched 150 VCs. I wasn't even particularly passionate about VC. But in the early days, the deal flow was really good, right? So my first deal was PipeDrive, which sold for 1.5 billion cash. The next one's Algolia, which hopefully will IPO next year. I was the first seed investor there. Third one is Talkdesk, which is doing hundreds and hundreds of millions. It'll IPO. The fourth one was Greenhouse, which was bought for almost $1 billion and will IPO. The next one was SalesLoft, which was acquired for $2.5. I was 5 for 5. And it wasn't intentional. It wasn't that I was, a Bill Gurley or Keith Raboy or whomever. It's just at the moment in time, it was a great intersection between not that many people interested in SaaS, and David Sachs was still running Yammer. I mean, there weren't that many people. Now, fast forward to today, there's 100 founders with investing that were much better founders than me, right? And they're investing on many levels. There aren't as many people that have built up the body of content in a media company because it takes a lot of time. Certainly Harry has. There are others we could chat about, but it was an accident by just wanting to, by not trying to monetize this, not trying to go big, not trying to sell courses and horses, but just sharing my learnings and stumbling into venture. And it has worked out, but that's the long story. But I will say I have reflected over the years. I don't know that the two are as synergistic as outsiders and LPs and folks think it is. I'm not sure they're synergistic. I'm not sure Harry agrees they're synergistic for that matter. There's a partial synergy. And then I will summarize this. What I have learned from all this, if you just want to do venture, you could do no marketing, okay? But even if you do no marketing, folks that do no marketing, they don't have a Twitter account, they don't do social media, they do marketing. You know what they do, Eric? They drop by the office of pre-seed investors. If they're an A investor, they invite the seed investors to dinner. They're always doing marketing. Sometimes they're doing enterprise marketing. Like they're not always doing consumer marketing, which is in a sense what I accidentally did. But all VCs do some kind of marketing, okay? Some kind of marketing. But my learning from SaaStr for investing, if you do too much, it's bad.
Oh, really? Why?
You want to do I can't draw my 2x2 or my whatever. For venture alone, you want to do the least amount of marketing that generates the maximum number of decacorns or unicorns. And any minute you spend doing a podcast, writing a blog post, responding to a crazy tweet from a billionaire that has nothing better to do, any ounce of energy you don't put into investing beyond what it takes to get whatever, the SalesLoft or Airbnb or it's a wasted, isn't it? It should go into deals.
Fascinating. Yeah.
And I don't think anyone gets this right. And I think almost everyone in venture that has been doing it for a while has felt like their edge has eroded. I was just talking last week, and I won't say it was someone with a very low profile that has to be one of the top 5 seed investors of all time. Certainly doesn't done anything to BB. I will leave him nameless, but he's so good. And he's mostly retired, although he's young, mostly retired, not retired on a ranch, actually retired as a builder building. And I chatted about it. He's like, I feel like I've lost my edge. I'm like, I mean, I have a pretty good track record, but anyone looked at yours, they would fall out of the chair. It's like, I feel like, and I don't think he's lost his edge, but everyone feels like this. And so many VCs are trying to do podcasts or create newsletters or YouTubes. And I think it's all good for founders because that's helpful. But I don't know. I think it's just like table stakes or misguided marketing, or it just, so anyhow, you want to do the perfect amount.
Yeah.
VCs have to market, but they all market differently. And some of them don't even realize they're doing marketing.
What do you mean when they don't realize they're doing marketing?
Look, if you're let's say you're someone like Mamoon Hamid, okay, who runs Kleiner. People love Hamoon up and down the stack, but he does a lot of lunches and dinners.
Yeah.
You don't see, I mean, Mamoon does, and I love, he taught me about venture. He's one of the first people I met when I started to invest. Aaron Levy told me to go meet him, and I met him, and I gave him Greenhouse and Front and a bunch of other deals that we did. And, he does, you don't see him on 10,000 YouTubes, do you? A couple, right? But it's like a favor.
Yeah.
But he, in his own elegant way, I talked to so many top VCs and they're like, oh, I just had this lunch with Mamoon, or I was just at this thing. So in his own way, he's got to build out his spider web to create deal flow with founders and other folks. So, but that's not what it looks like on Twitter. Twitter, everyone with a $3 million fund is doing 88 tweets a day. That's their marketing.
Yes, exactly. Yes.
Sharing all their brilliant learnings from their one markup. This is how you do venture. I got one Series A markup last week. I know everything.
Yes. Yes, definitely a lot of that.
A lot of that.
And so what does edge look like in venture anymore? What are real edges?
I don't know. I'm still trying to process it. I don't know. I think that I don't know that there is a true edge. I know LPs want there to be an edge. I think that there's so much capital at the seed and pre-stage. It's so much since there's so much that you still want to be picked. Being picked is the edge. Being picked remains an edge today. But beyond that, some of it, I think it's just tough. If a founder that is in the upper right of the 2x2 of like hot and a little bit of traction, and they have the right kind of hot. It's just, I don't care. Outside of March 2020, like it's just not that hard to get funded, right? It used to be like if you were a hot Series D company, there were only 20 investors, but you'd get 20 term sheets, right? If you were at 50 million, growing to 100%, low burn, you'd go meet with all the growth and crossover investors and you'd set a data room and you negotiate. There were no data rooms for seed investors 8 years ago. Now they all have data rooms. I'm being fishy. I mean, it is still seed and pre-seed. To have that experience, you still have to be privileged. You have to have the right background. You might have to come out of Stripe or Y Combinator or have the perfect pre-seed. Like it's not easy. But I don't know that there's a magic edge, but it really still helps to be picked. But I think folks that are just good pickers, it's tough in seed. It used to be great that seed investors, people struggled to raise it and you could just be a great picker. But I don't know that there's room for great pickers in seed and pre-seed anymore. There should be, but I don't know. I don't know that there is.
Right. Is it just too crowded?
I think you have a luxury of time when you hunt for outsiders. When you hunt from outsiders. But too many folks want to be in the upper right of the 2x2. They want the person that came out of Databricks or OpenAI, and they want early but a little bit of strong growth, and they want the right thing. And they're just those should be priced to perfection. That's the marketplace, right? And in fact, the problem with venture is the stuff that's priced to perfection in the short term is horrendously overpriced in the short term. Maybe not the long term, right? But we thought, what did OpenAI do the penultimate round at? 20 billion?
Yes.
We thought it was crazy. But you could have flipped your pseudo shares in a year for 80 billion. So it wasn't crazy, but it was certainly priced to perfection. So I don't mean that this media, if you want you can do it, this overlap of like media, community, and venture. I do think it's interesting, but I would just caution folks to not over expect from it. And like many things, don't try to emulate what else you see there, because I don't know that it's more nuanced and harder than it looks, right? I would say I have a pretty good following in cloud and SaaS. Okay, I think it's pretty good. It's high on the list for many years. I would still say I am lucky to see one company where I fall out of my chair a month. Everyone talks about deal flow. I think they all lie or are delusional, right? I was just talking to someone, watching a video this morning where someone was saying how they had to see 1,000 deals last year. I'm like, well, I guess it's possible.
Right. Yeah.
I don't think I could see 3 a week. That's all I could do is 3.
Right. Three actual deals that are yes.
To be present, to be thinking through it, to follow up, to do work. 3. So, and I'm lucky to see one with whatever I have, the community, deal flow, brand, life experience, catharsis, whatever. I'm lucky to see one, not good, but where you fall out of your chair. And when I reflect on my learnings from the last 24 months, learning since 2001, the worst investments I made, I didn't do any, I don't have enough money, but I didn't do any like 100x crazy deals myself. I had a couple in the portfolio, but I didn't do any myself. But the mistake I made in 2001 that I'm now having to dig out of today is when I invest in anything that wasn't great. Right? And so all this energy, 10,000 blog posts and 782 this and 4,000 Quora answers and millions of newsletters to meet one a month, I fall out of my chair on one.
Fascinating.
One. If you had a more efficient way to do it, don't do the social media, don't do the community, don't do the content. Find one other way to just be Mamoon. Go meet with the best pre-seed investor and have him just say, hey, this is the best one in my portfolio. Just go meet with that one. Yeah. Don't do all this other stuff. It's dumb.
You're being modest. It's worked for you, but you're saying you spent too much time or too much. You could have done it in a more efficient way.
I think folks who have the problem with this is a very niche topic, but the folks who have really large communities and media businesses, and I think of SaaStr more as a community first and an accidental $30 million business second, because it's not intentional and it's not heavily monetized, but it just becomes a 14-month a year job. I mean, you talked about Harry, and Harry I've known since Harry actually dropped out of college because he read SaaStr in 2015 and was a fan.
Yeah, you gave him the podcast, the SaaStr podcast.
Yeah, and his like the amount of energy it takes to produce that. I mean, you're producing podcasts now; it's a full-time job. How are you supposed to produce multiple pieces of A-tier content a week and deal with 12 boards and 8 struggling portfolio companies and do 1,000 pitches a year and deal with angry partners and force out the partner that has no good deal and force your partner off the board of Klarna and then undo that? Like, it's just, how could you do all of it? You can't.
Right. And so when you mentioned media community fund, when I think about in the last 20 years, who's done that, as good as anyone or the best, maybe it's YC, right? They've done a phenomenal job, with their sort of book face.
Better than anyone realizes.
Yeah.
YC has created billionaires. What other entity like this has created billionaires? Nunce. What my made up word is nunce. Nunce has. Nunce.
And so what I've wondered about you, given that you've been the best content guy and brand guy and media guy and community guy for SaaS, is why not create the YC for SaaS?
It's funny. When I started my own funds, I got a lot of pressure from the LPs to do it. And I'll tell you the answer, which may be less interesting, but it's not my passion. I sat down and I said, listen, if I want to do a YC for SaaS in 2016 would have been very easy to do. YC then went through a phase change where most of it's SaaS. Now it's all transferring to AI and others, but it would have been very easy to do in 2015, 2016 would have been very easy to do. We had a co-working space with 100 great startups, multiple unicorns in it, could have easily asked everyone for 7%. But I thought about it, I'm like, God, then I got to hire like 20 people. I got to divide the carry up 20 ways. I got to deal with their headaches. I'm like, I regret selling my last company, but one of the reasons I did it was not to have these headaches. A lot of founders want to get rid of the headaches. Now I got to deal with 20 ego-driven pseudo partners, each arguing over 1% carry, squabbling with each other, backstabbing each other. Then I got to sit in the damn meetings and listen to the 100 stupid companies they want to do. And then even worse, you know what they do at YC? Maybe Gary doesn't have to do this, and I do love Gary since we started investing together. But I can't read all those applications. I would jump off the roof. I hate, I'm a decent investor. I hate pitches. I can't stand them. You'll never see me at a pitch competition. I used to go to the YC demo days when they're live, but it was mainly to say hi to people. I just couldn't even list. I don't think there's anything more boring than a pitch. Now, meeting with that one founder a month where you fall out of your chair is magical. That one meeting, any other pitch, I literally am like, I sold my company to not go to crappy meetings.
Right.
If I wanted to go to crappy meetings, I would have kept running my company. That's what I think every time I'm in a crappy pitch. I'm like, oh, or I take a favor pitch. There's nothing worse than a favor pitch. Right. Could you please meet with Eric? All right, Eric, how you doing? Well, we haven't grown the last 4 months. But if you help me full time, I really think, and help me hire a whole sales team, I really think we could grow again. I'm like,
yeah, no,
I want to end the meeting immediately, but will he write about me on Bookface? Okay, I don't know what to do.
Right. And I mean, Paul Graham's life doesn't look that hard. Of course, maybe 15 years ago when he was just starting, he had to do a lot of terrible meetings. And
those guys, listen, the guys I've talked to, when I've talked with Nicholas Dessain, who used to see CEO of Algolia that I invested in, he's a partner there. When I talked with Justin Kahn back in the day when he was there, actually, those guys love reading the pitches. I think I asked Michael Seibel backstage at SaaStr Industries. He loves reading those, right? I don't know. It's just not me. You have to play to your strengths. They'll sit. I guess they used. I don't know what it's like today. It's more professional under Gary. But in the old days, Justin told me they'd sit in a room, right, 8 of them, and they'd bang it out for 3 days. They'd read. I mean, not literally like scripts, but they'd sit in front of their monitors, and for 3 days they'd read thousands of applications. You'd read one in 90. I get it, right? It's probably like Hollywood a little bit, right? But to me, that's a kiss of death. So people ask me what it's just there. The other thing about seed investing is there are exceptions. But mostly, it's not the best way to make the most money, especially measured against unit time. You want to manage billions. You want to do Series A to B rounds. You want to only invest. You just want to win the bet. This is what I learned from Byron Dieter early on, another mentor for me, who runs the Bessemer Cloud practice. Is his job is to win the best deals. He's like, that's the job, is to win them. Founders love Byron. He gave me a term sheet back when I was a founder. So I knew him when we just started our careers, when he was just started as a non-partner, I think. But, people love Byron, and he didn't need to be the first guy. He just needed to be in every deal. And then people they like others too. I think Mamoon has some of these characteristics as well, but he would just win the deal. That's what you want. Put 10, 20, 30, 40, 50 million into whatever, Procore, Twilio, SendGrid, just do them like clockwork. Forget about these little checks. That's a waste. That's too much work. Little checks are for suckers or for starters. They're for starters or suckers.
If your picking is good, then you want to be focused on make sure you have enough time to win the best companies, or if the market is efficient. If it's hard to know who is the next SendGrid or who is the next Algolia, then the YC approach makes sense. And that's why they do it super early when it's hard to know and get special economics for it, or the pre-seed and seed.
Well, maybe if I think about the Garys and the Byrons and the Mamoons and the others, maybe, and I think about why I didn't do some of the things you asked, right? I think people will disagree. I think you got to play to your strengths, and people's life experiences, their tolerances, they actually line up to different check sizes and stages. And it doesn't necessarily mean you get to start there, right? But like for me, I'm naturally a late seed guy. Okay. I'm all about this. I'm very passionate about sales as a practice, as a craft. And people love SaaStr for this, but that doesn't help for pre-revenue, does it? I mean, a little bit, but it's not that. And it doesn't help for growth. Right. But for folks between 100K to $1 million in revenue, they're searching for the questions that SaaStr has the answer, but it's my passion. That's my passion. Right. And Gary left, initialized, and, the economics are none of my business, but we have a large LP base overlap between initialized and me. And they were sad. The LPs were sad. I don't know how the last funds will do, but the first couple funds
phenomenal, right?
Yeah, man. And so I'm sure Gary will make insane amount of money running YC, but I can't imagine he would make that much more money than just running Initialize the way he did. So what my point of the rambling story is, it's his passion. Gary, I wrote some tweet about Gary going to YC. I forget what I wrote, and he wrote back, "YC saved me." It's his passion, right? And it's, for late stage folks, I think their passion is purely making money. And you got to respect it. It's not me. I'm a founder. They're not founders. Late stage guys usually aren't founders sometimes, right? But they're all about, how big's my house and what's going on at Palm Beach and which house I got to upgrade at the Yellowstone Club next season because it was embarrassing to be high up on the mountain. And it sounds dumb and douchey, but it's a goal, right? At the growth guys. And if that's you, then you should go figure out how to do the next Tiger or Insight, but make it work better. Right. And so if you really want to be serious about investing, you got to find the match for you. And for me, it's quirky. It's doing 3 to 4, ideally late-ish seed deals a year where it's founder led and they're trying to figure out sales and they want me, and it's pretty quirky. But anything else I've done, I have not enjoyed. Right. I've not enjoyed it.
And so say more about how you've netted out on your sort of portfolio size, fund size, because you've been successful, so you've had flexibility or different forks you could have taken. Were you close to taking any of them? Did you ever, were you close to wanting to scale or scale up the operation in some way, or take a lot more money and fund? Or how did you think about this?
Well, I definitely think the way I've done investing is dumb.
In what way? Seems to have worked.
Yeah, but basically I've raised, 2 small, what now would be smallish funds of about 70 million, and then 2 small growth or opportunity funds to complement them. And then actually I've put my LPs into a lot of deals. So my LPs have invested another, say, 70 million direct into the best ones, right, through me. So, but this is dumb. What is smart, if you have a platform of any sort, you want 6 people doing all the work for you. I look at for example, someone that is under the radar that should not be is David Cummings. Most folks that have not been in SaaS world don't know David. David may be a billionaire. I don't know it doesn't matter. But David started a company called Pardot that was acquired not long after EchoSign was. So we started at the same time. It was acquired by ExactTarget, and then Salesforce bought it. And Pardot now does $500 million under Salesforce. Adobe signs in decline, but it still does over $200 million of Adobe. Our lives were parallel. The main difference was he bootstrapped his company and owned 80%. So he walked out of ExactTarget with $80 million in cash. He turned around, bought a decrepit skyscraper in Atlanta for $15 million, turned it into a tech village. I copied that with our co-working space back in the day. And then he just started co-creating companies. He co-created SalesLoft, which sold for $2.5 billion. He was the first angel in Calendly. The list goes on and on. He became the kind of the quiet king of Atlanta and played to his strength. And he's got this group and that group. He's got 50, 60 people doing all this stuff or whatever it is. I did this dumb thing of I was unable to find. We have a pretty good team on the community event content side. Like, it's pretty good, but I wasn't able to find the right people on the right journey with me on investing. I tried and I've failed. I've brought multiple people on to work with me. And maybe if I was more a money manager, I would be more Machiavellian about it, but I'm not. I'm a founder, and I didn't find my co-founder in investing. Let me put it this way. If I'd found my co-founder, and I had one not that long ago, there was one person who will go nameless. I have pretty good, right? I offered this person half of all the carry. No one does this in venture, right? Does anyone offer you half the carry off the bat? But I knew that this wasn't just another investor. I knew this could be my co-founder, right? So so I said, listen, like, I know that if I give you half of everything, either 1 + 1 will equal 3, or at least my life will be better. My quality of life. One of the two. Either my quality of life will be better, or I will make more money, or it will be better. We will do more, or we can go out and raise more money and you can deploy it. So I don't have to deploy it, right? Ultimately didn't want to do it. Wanted to join a huge mega fund, which is what this person ended up doing. But that's what I failed at as an investor, was finding my co-founder rather than finding a bunch of mercenaries, which is the truth is most funds have investors, but they're kind of a bunch of mercenaries. There's rare examples like ENIAC that really were friends in elementary school. And Homebrew is very interesting. Satya in particular was very helpful for me when I started. And I always thought he and Hunter were an interesting pair years ago, but they really are venture spouses, aren't they? But it's rare. It's rare that you find your co-founder, and I think Satya and Hunter did, and I think the ENIAC guys did. But that's what I needed to scale, and I failed. I failed to find my co-founder, right? And I haven't given up, because I literally offered someone this 50% carry in the last 24 months. So I'll never give up until they roll me out in a wheelchair. But I didn't want to scale on my own. It wasn't fun enough. It's not enough money. I don't need that. It's just not worth it. It's 14 years to get the carry, and it's a lot of drama. And I already have a car.
And so do you think you found the sort of final form factor of what SaaStr is and will be at the fund level? And it's just, hey, how do we rinse and repeat? Just do amazing fund after fund? Or
no, I don't think I've figured it out yet. I just learned there's the fund and there's SaaStr Inc. I would like to get SaaStr Inc. It's hard. This year will actually be a tougher year, but I would like to get it to 100 million. That'll be fun. That'll be fun to get it to 100 million. And I have never fully figured out venture at all. But what I have learned is it's hard, but you just, if you got to be patient. There's no point in doing dumb deals. There's no point in forcing things. There is point in going all in, go all in on your best deals, don't hold back, but there's no point in going further than that. Right. So, if you can see one fall out of your chair deal per month and do a couple of those a year and end up with 3 or 4 fund returners per fund, you do pretty good. And I don't actually like the way I invest, but, I know we will always make money, 0% chance. If I only pick the best of the most high velocity inbound SaaStr fans that have good growth and good metrics and great CTOs, and I just pick a few of those a year, I may never approach the returns of the best, but I think I can do top decile. Right? It's enough. It's, I don't think a venture is a mitzvah. Right? I think being top decile is a good goal. Forget about Twitter, but I feel like, and I also feel like this approach, I don't really believe that like doing 50 investments per fund is such a great thing. Like I don't believe the math diversifies risk, but I do believe if you have enough good deal flow and picking, you can almost guarantee you're going to make money in venture. You can almost guarantee it. You just need, if you can, again, venture is about making one great investment a year until you're a mega fund, right? One a year. And you can even 18 months is okay. Right? Even 24 months is probably okay. Like as long as you have some good ones, right? It's not, if you have an engine, and I suspect all the best investors, one or another, like it is stressful, right? But I think they all have an engine that at least sort of works so that they can get one or two great deals a year done, right? It's all that matters. Nothing else matters in venture except getting one or two. It doesn't matter if you add value. It doesn't matter if your NPS is low. All that matters is every year you get into one or two good deals, and maybe in a small fund, maybe even just one's enough.
So the person who joined the mega fund instead of joining you, separate the person, that decision, the economic calculus between co-founding something smaller or joining a mega fund, is it basically there's higher risk, higher reward, i.e. if you perform really well, you'll make more money in the earlier stage or what's the way of thinking about it?
No, I think the interesting learning was that this person in particular just wanted the benefits of the mega fund and was okay with the downsides. Like, okay, if you go join a mega fund, you know what the one thing is for sure? You work for somebody. Whoever it is, people may not get it who listen or watch. The bigger the fund, the fewer the people that run it. The bigger the fund, the less democratic it is. Some of the biggest funds literally have just one true managing partner, right? Many of the biggest funds have partners, general partners, but the boss determines half or more of the economic distribution. This is a classic hedge fund model, right? Hey, listen, Eric, I'm going to pay you $500,000 a year, and you're going to get $500,000 in this and that. And at the end of the year, I'll take the $50 million in profits, and I'll just decide, whoever, Steve Cohen, whoever, just decides who gets the $100 million. Venture funds are run this way too. The big ones are. So the good news is if you go to a mega fund, you can make $1 million a year easy in salary, right? And you can make more in carry. And actually the carry sometimes is very generous. It's surprisingly generous. If you have a small number of partners with a lot of dollars, the carry can be, you're not going to get half, but 5% out of 10 billion might be better than half of 100 million, right? Do the math, but you'll never run the place. So you got to decide who do you want to be? You want to run the place, right? What I've also learned is, there are CEOs going into venture is very different than like a SVP going into venture. The latter is usually more successful.
Why is that?
Because they know how to work for some jerk like me or you or whoever it is, whoever's running the fund, whoever runs, whatever, they know how to, if you're an SVP, a successful SVP at a really good company, not only do you know a little bit about technology and areas, you know how to work for whoever. Founder CEOs are quirky, right? They're great, but they're not easy to work with, are they? Even the nicest ones are hard to work for. Because at least we're demanding. Like we don't even know we're demanding. Founder CEOs, we're like every minute of the day we're demanding. Even when we're having a beer or just socialize, we're constantly just our presence is demanding, right? So founder CEOs don't even realize this, and so if you're a founder, a successful CEO, and you go into venture, be careful. A lot of them, it's not well written, but a lot of them bounce. A lot of them bounce. A lot like okay. Because if you're a CEO, you don't mind working for someone better than you, but working for someone worse than you, or not being you show up and you find, oh, I'm not a real partner. What's this management company that I hear of, but I don't get to go to those meetings? And how does this backloaded vesting over 10 years work? And why is carry deal? I thought you said I was a partner.
Right. It's funny. One example of this, I don't even know the details, but it sounds like it's an example of this. Phil Libin was like CEO at Evernote for, 15 years or something. And then he joins General Catalyst for like 3 to 6 months or something, and then goes out and starts his own incubator again. And my guess, I'm not close to him, is just like he did some calculation of what you just described of, hey, I'm used to running the thing. I'm now.
It just wasn't a vibe check. It just didn't work for him. No matter how much they pay. I mean, General Catalyst, not everyone knows them, but I mean, they could pay them whatever they want in salary, right? The mega fund's salary doesn't even matter. It doesn't. It does. I mean, it matters if you have 1,000 people working at your fund. But if you're forget all your, it's just if your partner's title at a mega fund, it doesn't matter, right? If you have 100 million in fees, people think these fees are not free. You have to return the fund, like it's real work. But the short-term economics, the folks that run the fund, if you're whatever, who's the guy that runs Vista, Robert, whatever. I mean, he's making billions, right? And probably used to have the majority of the economics. But if he's got to pay you and me $2 million a year and we deliver, he doesn't care, does he?
Right.
He doesn't care.
Hey, we'll continue our interview in a moment after a word from our sponsors. Over 100 startups launched today. Do you know who they are? If you're not seeing interesting startups, none of your downstream processes matter. How you source deals at the earliest stages could be your most consequential investment. Harmonic is the most complete startup database, finding new companies as soon as they incorporate and tracking them through IPO. You can create a search tailored to your investment thesis. In one search, filter over company data, including venture stage, industry, and geography, founders and operators' backgrounds, and traction metrics like headcount changes, social media audience, and web traffic growth. Importantly, Harmonic instantly surfaces warm connections to help you connect with founders. The results are delivered on autopilot, wherever you most need them. Over Slack, email, or via API, directly into your CRM, integrating seamlessly into your software stack. Learn why Craft, Bedrock, NEA, and hundreds more trust Harmonic's data by visiting harmonic.ai or use the link in the description. Make sure you mention our podcast, Turpentine VC, during your demo. Hey all, Eric Torenberg here. I'm hearing more and more that founders want to get profitable and do more with less, especially with engineering. Listen, I love your 30-year-old ex-FANG senior software engineer as much as the next guy, but honestly, I can't afford them anymore. Founders everywhere are trying to turn to global talent, but boy, is it a hassle to do at scale, from sourcing to interviewing to on-the-ground operations and management. That's why I teamed up with Sean Lanahan, who's been building engineering teams in Vietnam at a very high level for over 5 years to help you access global engineering without the headache. Squad, Sean's new company, takes care of sourcing, legal compliance, and local HR for global talent so you don't have to. With teams across Asia and South America, we can cover you no matter which time zone you operate in. Their engineers follow your process and use your tools. They work with React, Next.js, or your favorite front-end frameworks. And on the back end, they're experts at Node, Python, Java, and anything under the sun. Full disclosure, it's going to cost more than the random person you found on Upwork that's doing 2 hours of work per week but billing you for 40. But you'll get premium quality at a fraction of the typical cost. Our engineers are vetted top 1% talent and actually working hard for you every day. Increase your velocity without amping up burn. Head to choosesquad.com and mention Turpentine to skip the wait list.
Let's get into the SaaStr media business, particularly sort of the business model and the different things you could have chosen but decided not to. Why don't you talk about sort of the evolution of the business, and then let's talk about how you get from 30 to how'd you get to 30, and then let's talk about how you get to 100.
Yeah, well, look, it was all an accident. I mean, unlike folks today are much more intentional, I think, because there's more people to copy. I didn't have anyone to copy other than that little bit of Mark Suster's blog. Copying a blog is copying, but it's not really copying much more than that.
You built on top of it.
Yeah, a verticalized version. It was just more an inspiration. But I mean, the simple answer is, look, I started writing this blog, and then like the first day I wrote it, I wrote the first real post was called "Everybody Lies," and it was about real revenue for a whole bunch of people before they IPO'd. And I wrote it, and I got a like from Aaron Levy. Okay, so I knew Aaron, but I didn't think he'd write. So I kind of got inspired, right? And so it took off, and I saw more things happen. And then I'm like, a couple months, I'm like, okay, well, I've never been to a meetup in my life. Like, I'm not that social, but let's do a meetup with nothing, no content, no anything. And like, it sold out 400 people. And I'm like, oh, that was cool. And then like, okay, let's do another. That was like in 2012. And like in 2013, let's do another meetup. And now I had like one session with my old VP of sales. Like 800 people, 700 people came. And I'm like, wow, that's a lot. I'm like, and so I said to a friend of mine who did these small events, I said, let's do a SaaStr annual in 2015 for a day. And, you know, it sold out. We had 1,800 people come. And then we did the next year was 3,000. So the point of that story is I did not intend to like be producing mass scale events with hundreds of sponsors and media and stuff. It was truly organic in a way that I don't think would happen today. It was very innocent, right? It was literally like, I don't like meetups, but, and I like, it was really born out of me being forced to go to like parent events at school and not knowing what to talk to people about unless they were the SaaS CEOs. Like I would hide in the corner and see the couple of folks at school who were SaaS CEOs because I knew what to talk. I just couldn't just talk about like skiing or the grass or football. It's just not. I got like 8 minutes of that.
Right.
But I could talk about SaaS for 2 hours. And so I'm like, okay, I kind of like these meetups, even though I wasn't that. And so anyhow, so this event thing took on a life of its own. But then the problem was, Eric, is that it all broke every year because events are so expensive and complicated that I just couldn't, I outsourced the first 2 years. Okay. First year, we had 400K of revenue. I wasn't even paying attention. Okay. We had 400K of revenue without trying. It cost 200,000. I gave 100. So we had a 200K profit. I gave 100K to the guy that spent 10 hours or 20 hours putting it together. And I gave 100K to the person that was helping me work part-time. I took 0, 100K to each of them. Great. But next year, 3.6 million. Okay. Without, and I didn't do anything. And the great thing was, it's about a week before SaaS, the second SaaS round in 2016, where we got 3.6 million in revenue. And the outsourced person that's helping me says, good news. We got a $2 million surplus. Whoa. Like, I didn't even I didn't know how anything worked. Like, I didn't care. I had a life to live. He's like, yeah, you take $1 million, I'll take $1 million. I'm like, well, you keep your $1 million. I will pay some of my $1 million to the team that's helping me, and I'll put some away for next year. I don't actually need any of the dollars, but you take your $1 million, great. That was like Thursday before the SaaStr annual. On Saturday, we get an email. He's like, oh, I forgot to put food and beverage into it. He forgot to put 1.6 million into the budget. And then the mistakes compounded.
I know.
And we went from a $2 million surplus to nothing out of the 3.6 million. It was all wasted. And then everyone that worked on it quit because of that. They didn't want to own up to their mistakes, so they all quit. So after the second one, I got no help. And it's like, it's 400, 3.6 million. I got no one to help. I start interviewing everyone on the planet. I've never met a less ambitious industry than events professionals. I interviewed 100 people. I've never met less ambitious people. And every year, until we kind of have a CEO, SVP, Amelia, that runs things now, until she took over, which was really during COVID, it never functioned each year. It was so hard to find anyone good. Then there's like these agencies that help you produce these mass scale events. I mean, we have 12, 13,000 people in SF. These agencies, they're all basically built on ignorant clients and ripping them off. This is an industry of ripoffs. And so what would happen is someone would come in and they would be like, well, you have to use this terrible AV company that's $2 million a year, and be like, I don't think I have to. And it turns out it's their cousin's company. And it turns out of the 2 million, they're taking a 500K kickback themselves. And it turns out for 1 year, they're only willing to record audio. 1 year, we didn't even get video off 3 stages because the captive person that was a cousin was only willing to do audio. So you know how much time it takes to work through that level of mediocrity and all the and this whole industry is based on every bigger event you've been to, at like the bigger ones, they're all basically, no matter what anybody says, when you interview these folks, they all lose $2 million. They all lose $2 million. And I didn't want to lose $2 million every year. Like, it wasn't fun for me, Eric. Like, if I had to like save the world from COVID, I would lose $2 million, right? Or save people's lives. But I really didn't want to lose $2 million every year putting on the SaaStr annual, with 11 thank yous. So anyhow, maybe that's much more than you asked. So it's very interesting, but we can talk about the business itself. A meta life lesson is I'd never been in an industry before. And I've done as a founder, I've done hard tech, I've done software, I've done, crazy stuff. I never found an industry where I couldn't find like these incredible people. Like, even if there's only like 5, like you hunt them like a heat-seeking missile. Find the best scientists in your industry, the best technologist, the best developer, do whatever it takes, give them whatever they want. Just ask them. And, but for this mass scale events thing, and trust me, I know the people at ShopTalk, Money 2020, so many places, a few folks at website, they don't exist. There are no gurus.
Interesting. But I mean, aren't these businesses massive? Like Money 20, didn't it sell for like $300 million?
Money 2020 does about 100 million revenue today. It's sold for 100. A lot of the stories on the internet are always inflated, aren't they?
Yeah. Yeah.
Hooray, our startup sold for 400 million. We raised 600. The stories there's always some asterisks and daggers against the operator version of most stories. But Money 2020 is very successful. ShopTalk sold for 150 million at about 25 million in revenue. So there are stories. if you're really interested in the business model, if you really want, I consider SaaStr a community plus events plus digital media. We do about $2 million a year of digital media. We should do more, but we do about 2 million of podcasts and newsletter and other stuff. And then whatever the balance of the 30 is ultimately events related, primarily, not entirely. But the real play of these events things is the unit economics are terrible until you break through massive fixed costs. Okay. So for example, SaaStr annual costs $10 million to put on to turn on the lights. So if you bring in 6 million, it stinks, right? If you need 500 people, it stinks. But if you can have a small team and do 20, then actually you can make 10 million, right? So what the handful of public companies in this space do is they aggregate 3 or 4 properties, and the operating margins are pretty good, right? They find folks that are at scale that have 30+% real operating margins, real free cash flow. And maybe Money 2020 can only do 100 million, and Con Lion does like 150, and Shop Talk does 80. But if you get 4 or 5, if you buy one every couple of years, you can have a business that deserves tech-like multiples, doesn't it? If we can do hundreds and hundreds of millions, growing 30% or more a year with 30 to 40% operating margins, that's a tech-like business with some recurring characteristics, right?
And so getting from 30 to 100, is it you're doing more events, or just the events get bigger, or are you adding different business lines, or what's the biggest lever there?
Well, look, the last 12 months have been hard because this will be our first year without, we'll be lucky to be flat. We'll probably be down because of the unicorn implosion, because about 30% of our sponsors just don't exist. Okay, you can't make that up. We're making that up in some extent with better folks. We have a bigger partnership with IBM, bigger partnership with Oracle, bigger partnership with Cisco, and that's great stuff. But you can't make up for the willful abandon of marketing spend of 2021. It'll take a few years to get back there. But the simple answer is just this: look, and people don't get this. 40% of all marketing spend goes into field. 40% of all marketing dollars go into field marketing. Field marketing is annoying. It takes a lot of work. It takes humans. You got to fly places. You got to have a popcorn machine. You got to do a lot of things that feel very old school, don't they? A booth. But the thing is, it works. And the reason field marketing works, which took me about 8 years to figure this out, I didn't know when I was doing field marketing, I didn't know when I was doing this, is look, it's really basic. The best events in business, we could talk about Coachella and some other things that I've learned about too, but the best business events do something very fundamental. They bring, by their nature, the best buyers and sellers together. They are a marketplace. It is a weird marketplace. It is not eBay, right? Or whatever. But the best buyers go to 1 or 2 events a year. And they go either to meet their existing partners, or they go to meet ones in the pipeline, or they go to ones they are interested in buying. Oh, hey, Drata or Vanta or whomever, I need to do this SOC too. It's good to see you here. Tell me a little about it. That's super valuable. Hey, like I'm a little bit on Google Cloud. I'm a little bit on AWS. I'm thinking about doing this. AWS, I can't talk to anybody, but Google Cloud's a 5-year SaaStr annual sponsor. If I can talk to someone good there, it can tilt the deal. So my point is, not everyone's good at this stuff. Like you and I probably aren't good at field marketing, but it's 40% of spend. So that's the thing that's not obvious, right? So how could SaaStr get to 100? Well, how much is cloud growing each year? Significantly. So the simple idea is, look, if you have a top brand and you attach to something that has certain macro growing characteristics, if you can even increase market share a little bit over 3 or 4 years, if SaaS overall is growing 20% a year, grew much faster the last couple of years, and you do that for 5 years and you increase your market share, you should be able to go from 30 to 100, shouldn't you? Not in a week. It's not. You can't even. It's going to take 5 years. It can't be done in a week like OpenAI. But you have been a strong brand where you create that marketplace, and you have the macro trends. And these macro trends, in investing, it takes us a little while to see them. But I've got a couple of investments that are in the Shopify ecosystem. You can literally see them accelerate as Shopify accelerates, right? It's like high correlation, right? So that's how you get to 100. Is just that cloud is even with this last year being weird, with a lot of budgets being cut, but so much money going to AI, it's like a weird year. It's still a force of nature, right? It's SaaS is 200 billion, but overall business software will cross $1 trillion this year. $1 trillion in spend, right? So, but this 40% into field marketing, I did like 6 SaaStr angels till I even knew this.
Yeah, it's fascinating. I've been trying to study these businesses like Industry Dive or Informa, these kind of like vertical specific.
Yeah, Informa is one of the ones that does these roll-ups and other
Yeah.
things, right? Some do it better than others, but yeah. But you got to have, some of them used to have like an old, if you study, and you've probably studied Informa more than I have. Some of the old model was have 200 events, right? I think the old Informa, the old Essential, the other model was, look, we're gonna have the oncologists of the Florida Panhandle, and we're gonna have the hematologists of North Saskatchewan, because they're all, we can make a 500K or $1 million on these, and we roll them up. But I think the margins got so compressed in these subscale events that I think all of them abandoned this broad category, and they're like, hey, we want some $100 million type properties, right?
Yeah, totally.
There's more of them than you think if you really dig, right? There's more of them than you think.
You mentioned at the beginning of this interview, kind of offhand, that Harry might make more money than you with his media business.
No, I think he'll make more money investing and will invest. I think Harry will invest an order of magnitude more than I will. At least an order of magnitude.
And that's because he just wants to?
Well, he's starting earlier. 1, 2, I love my portfolio companies. 1, he started earlier. 2, he has more passion for investing as an investor. And 3, he's going to raise a lot more money. Harry will raise billions of dollars. He will raise billions of dollars before you know it. And he will ultimately be whatever he builds on hhis team, he will be, a very successful managing general partner of billions of dollars. I'll never manage billions of capital. I'm out before a billion. It's not my passion, but Harry will manage billions, and the LPs love him. And he's a good capital. He has a very specific model, and he's a good capital allocator.
Yeah. It's interesting. I'm trying to figure out my passion with this stuff too. And it's interesting because I helped start Product Hunt. I started on deck. So that's community media stuff. I helped start Village Global, sort of wide ranging seed firm. And I'm figuring out in 2024, kind of like, what's the combination of my passion and the best business model for it? Because in some ways it's been kind of like a hybrid or intersection between, so right now it's trying to build this media company that is something like a Lenny or Harry for X. You're trying to find, what you were able to help Harry do in terms of build his brand. I mean, in some ways, I used to say SaaStr for X, right? Like vertical media. You went really deep, able to create both media business and investing business. If we could help other people do that for their areas of expertise, and help them get started, give them a platform, pay for their salary to leave their job and go do it. Maybe there's some roll up there. I'm curious for your reaction to that idea, or your broad advice for me. We're just chatting for the first time in person.
Well, maybe 2 things. First of all, a lot of these things, like when you really get to know them, they're more nuanced than they look. So what SaaStr is very different than Lenny or Harry, both of whom, I just got to know Lenny. I've known Harry since literally he was 18 years old, or 17, I think. But SaaStr is a trusted resource for first-party knowledge, first and foremost. Harry is an interviewer, and now truly an expert in venture, like off the charts expert. When he started, he was just a student of venture. Now he still has, we all have more to prove as investors our whole life, but but he is an expert in every part of venture. Lenny, I think, is a classic curious mind. He's like, to me, and I only know him a little bit, but having now interacted with him a bit, he's like the talk show host of product. Like, he has this curious mind, which too many people do podcasts and they talk about themselves or their product. They don't have curious. So he's great, but he is not like a trusted subject matter expert for scaling the product of your company, is he? He's a creation of media around it, right? And Harry is like that for venture. So I actually think you can build SaaStrs, but I don't think they're like that. I think they're more like Freight Waves and other things like this, where you have deep knowledge, and they're better than SaaStr in some ways. I think you could build that. My point is, it looks similar to those, but it's not. People go to SaaStr. It has to be incorruptible. It has to be unimpeachable. It has to be honest. It has to not be a game. It has to 95% of 99% of SaaStr is free. No one's ripping anybody off. No one's trying to over monetize you, right? Not that Harry or Lenny are doing that, but it's different, right? And so there aren't that many trusted sources of knowledge that aren't selling you crap, right? But I do think you could build those. You could find the subject matter experts that have passion around producing and creating lots of knowledge, and package those up very thoughtfully. But it's not the same as the podcast thing, I don't think. I think the podcast is just one way to distribute that knowledge.
Yeah.
Right. So the other point you said, for what it's worth, I really think pursuing your passions profoundly dangerous. I think it's a sucker bet. And even worse, I think it's become almost toxic on TikTok in 2024. It's terrible advice to pursue your passions.
Right.
Pursue what you're friggin' good at. I have built implantable batteries that have saved hundreds of lives. I have done so many things. I have helped founders make hundreds and hundreds of millions of dollars. I've created jobs. Like, I don't have passion around any of that, Eric. But it's what I'm good at, and I'm driven to do it. But passion, I just feel like passion, and I'm not being facetious. I don't mean to. I know that's not exactly what you said, but I just think for folks that, if this part goes out, be wary of your passion. Do not pursue your passions. Pursue what you're good at. There's a lot of this stuff I just don't enjoy that I do. I don't hate it or anything. Like, I don't do the stuff I hate anymore. Like, I'm done. Like, I have enough success in this world. I can do anything I hate, but I do what I'm good at. Not where my passion is. I don't do where my passion is.
It's a good dose of realism there.
Yeah, because the world is, in 2024, everyone's a quitter, Eric. Everyone's quitting. Everyone's a quitter, and everyone just wants to be a manager and not do work. And I can't stop this, but I just want people not to pursue their passions.
Yeah. Yeah, you got to do the hard work if you want to be.
Just do what you're good at, and you will become passionate about it, but it may not be your passion.
And then the question is, if you're good at building, community and networks and media stuff, and a little bit good at investing, it's kind of like, what is the?
You can't be a little bit good at investing.
Right,
it's not worth it. No. You want to know their lesson? It's not worth it being a little bit good at investing. If you're great. No, it's more like, listen, there are exceptions. Okay, there's the classic Uber angels, right? But in today's world, if you're a little bit interested in investing and you can't lead deals because you don't have a lot of money and you're whatever, and you're putting 25K or 50K checks into companies, even if they exit for $1 billion, you don't make enough money. It's not worth it. It's not even worth it, frankly, to invest in, unless it's a decacorn or better. It's not even worth investing if you can't own 8% of the company, right? Really more, because there's so much dilution today. And so investing a little bit looks good on Twitter, and it can make you, it's something to talk about at cocktail parties in Miami or Austin or wherever. But I mean, I literally will not write any small checks ever. The worst. Yeah, they're also a sucker trap because you're asked to help the company a lot. But no, I think you can only win in venture if you have to be relentless. You have to win large positions in iconic companies. It can't be a side hustle. Right.
And so if you were advising Lenny said, hey, how should I grow my business, and assume I'm equally excited about any path, should he take the Harry path in raising a bunch of capital and using the content as a sort of, lead gen or distribution for it? Or what should he do?
Listen, I don't have access to Lenny's financials exactly, or if I did, I certainly wouldn't share it with you. But to answer the question more in a hypothetical, Lenny's done some things saying that his business does $500,000 a year. Maybe it does more now. It certainly grows. I could see it doing more, right? Let's say it does 700,000 gross and 500K net to him just for fun. So he makes $500,000 a year, and he's actually an angel investor in some pretty good companies. So let's say, but doesn't own 10%. He doesn't own 10% of Linear or whatever. So let's say he's made some good ones. So let's say, adjusted for time, eventually he gets a couple $2 million checks back, $1,800,000. So he's making $400,000 to $500,000 a year from investing, and $400,000 to $500,000 a year from his media business. Really, just getting to know Lenny, you really have to you have to decide how ambitious you are in this world. If he can make $500,000 a year in current income, and then $500,000 a year in qualified small business untaxed income that takes years to come, but produces itself over time, I think 98% of the world's happy with that. I know Harry is not. Harry's an empire builder. To his credit, Harry is. I feel like I'm one of the most driven people on the planet, but Harry is more ambitious than me. I'm not even that ambitious. Harry is very ambitious. I don't know if Lenny is. I just don't know. But
let's assume he is.
Most people would cut off their left ear to have Lenny what Lenny has today, but he didn't get it overnight, did he?
No. And I think he makes a bunch more. I'm not sure, but I think he's absolutely crushing it.
He might make a lot more. There was just an article that like a year and a half ago that said he made 500 that he was on. Listen, if SaaStr Digital Media does 2 million, he could make more, right? It's none of my, and it's literally if I knew, it's none of my business. I'm just having fun with a published thing that said it was 500K, whatever, 2 years ago.
Totally. And I'm just using him as a stand-in for Packy or just any business creator who's an expert on a sector or a position and does investing on the side is the best way for them to make money. Because I'm kind of in this position as well, and to some degree, just going all in on investing, or is it building?
I don't know. I listen. I've never talked. I don't even know Pat. I've never read anything he's written. I know people love him, but I do think he's raised like $400 or $500 million. Right? It's a lot of money.
He's raised a lot,
but he's raised. I know he's raised hundreds of millions of dollars. I think we have an LP in common. I think he's raised hundreds of millions of dollars. Okay, so if you raise hundreds of millions of dollars, and a lot of these small managers charge 2.5% in fees per month as a solo GP. Yeah, it's hard for your podcast ads to keep up. But probably if he had, my guess is he really is a full-time investor with this media on the side. Lenny is a full-time media guy that is brought in, that great investors bring into the cap table. It's a different model. And being brought, if you have a brand, like it is something I thought about in the earlier days of SaaStr. Do I want to be the guy that's brought into the cap table? Do I want to because I would get these deals in the early days I brought in, right? Harry was that guy in the beginning too. And what I quickly realized is they all want me to like hire their whole sales team for them. Like I can't do that for a 25 or 50K check. I blow my brains out. But someone like Lenny who people love and has great distribution, he might provide just the right amount of value for a 50K check. Like that might be the perfect, going back to our conversation, I'm just hypothesizing that could be the perfect match to where he's good, his strengths, his business model. And maybe Packy's got to write $10 million checks, given this fund size, $5 million, I'm guessing, right? He can't write 50K checks. They got to be he's got to write 7-figure checks, right? And Harry writes $5 million. Harry's average check size is $5 million. Harry's average is $5 million. That works his model.
What do you think about the Tegas business model or sort of this business model of like, or PitchBook or Crunchbase, like paywalled data product that sells to investors late stage or hedge fund, private equity, et cetera?
Well, listen, I mean, I've gotten a few pitches over the years, and I haven't taken them far enough to really be an expert. I guess here's the thing, but I'll tell you my somewhat informed opinion. So what PitchBook sold for like a couple $100 million a ways back, right? I think Crunchbase may have been on the block, but it's got a real, it's had its upside, but it has a real business. It has a real data business, right? I think the thing I know when you're thinking through all these models, okay, in today's world, it's a weird world. People are mixing up so many things. Can a solo entrepreneur have $1 trillion business per Sam Altman? But then we have BuzzFeed, which needs 1,000 people to fuel the engine, right? I think we're not. We need to be honest about the amount of humans that a model takes, and for anything that is like you're talking about, anything that is media or data related, is there a ceiling? And anytime I talk to someone trying to sell things to PE and VC, there's clearly a real market, right? But no one I've talked to has told me how their businesses are going to accelerate after 200 million in revenue. So, and I just would not. I just think people, you gotta be in the right box. What was the media company that raised 40 million that collapsed after a year the other day?
Oh, I can't remember.
Some veterans of whatever, Business Insider or whatever, raised 40 million for their next generation, and they spent it all. It's gone, right? Because they needed 80 reporters and all of this. So I don't know. Can like I'm interested in those models if they can clearly accelerate after 9 figures of revenue, like clearly accelerate. But too many things. Like I want SaaStr to get to 100, but SaaStr itself cannot get to 1 billion. It is not possible. I'm not trying to be pessimistic. I could actually build you a PowerPoint that says it. I could build you a Google slide, but it can't happen. This is my life learning from SaaStr. It can't. There are certain businesses that cannot get to 1 billion, right? And pros and cons. I think keeping them lightly capitalized and lightly employed sometimes is well, it's always the right place. Sometimes the economics can be favorable, right? I mean, sell a company for 100 million you own 100% of. Is that better than selling a company for 1 billion you own 10% of? It's actually an existential question. It's an existential question. It's because it's what journey do you want to be on, right? But anyhow, I'm rambling. But I see too many data businesses decay. I see too many that have trouble scaling, and so that's why this is my really long-winded question of saying I'm not sure. I'm not sure. But VCs are cheap.
Yeah, and so maybe you only do that business if you own 100% of it, or something.
Yeah, but you can't invest in, if you're going to be a VC, like you can't own 100% of the company. Right. Like it might be nice if management owned any of it. I'm also a skeptic. Right. The other thing, okay, everything we've said so far, I feel like I have some life experience and some good knowledge. I'll add one other thing, which I do have some life experience on, but maybe I'm wrong on this next one, but I'll give you my opinion. Way too many people are trying to build too many income streams, too many compound businesses. Too many charlatans on Twitter or X are claiming, hey, I've got 11 $2 million SaaS businesses, each putting out $500K a year. So I'm making $6 million personally for my 11 SaaS businesses. Bless their soul. I don't know anyone that can run 11 businesses at the same time. I know Harry and I are both struggling to do what we do. Harry's struggling, and Harry's wildly successful. We're both struggling just to do what we do. That's like 1.5, right? Now you could hire 100 people, right? But way too many people want to do 11 pitch books or 12 data plays together. And, the folks that really do that well, the PE firms have armies. They have armies. So I would caution people to pursue their passions. I see so many folks these days, and I see it with mediocre founders, and I see it with a lot of sales executives now. I can't tell you how many VPs of sales I interview that have 2 or 3 jobs now. And you know what? Some of them do fine, Eric. Some of these VPs of sales do fine, but they never do great. How can you be VP of sales at 2 different companies and run a real estate business and do another business all at the same time? How can you? When I write this on LinkedIn or anything, I get lit up as toxic or whatever. But how can you run 3, maybe with 30 people? How can you run 3 full-time businesses, right? So that's why my point is, I think I'm right about this. My point is, I'm wary of these seemingly easy to aggregate businesses. I'm wary of it. Now, I do think if you can do it, and maybe you'll do it with these vertical SaaSters, I do think if you commit 1,000 hours a week and figure it all out and do new things, I do think it's a superpower if you can do this. If you can, but